So does anyone have any more questions?
Yeah, can you explain what operating leverage is, please?
Well, operating leverage, there's two categories of it. High operating leverage and low operating leverage. Low operating leverage, an example of that would be Walmart, when they have a relatively low fixed cost but a high variable cost. On the other hand, a company like Ford has a high operating leverage because their fixed costs are much higher than variable costs.
So what's a fixed cost and what's a variable cost?
A fixed cost is a constant cost that a company incurs to produce their products. They stay the same for certain tasks that the company has to complete to produce their product.
And then what's a variable cost?
A variable cost is a cost that a company incurs for every unit that they produce.
Go.
So, Professor, is there a formula, or how do you find out what a degree of operating leverage is?
The formula for operating leverage is contribution margin divided by net operating income.
Contribution margin is you subtract fixed costs from sales revenue, right?
Actually, you subtract variable costs from sales revenue to get contribution margin.
Oh, okay. And what exactly is net operating income, Professor?
The way you get net operating income is you take sales revenue minus variable cost to give you the contribution margin. Then you subtract fixed cost from the contribution margin and you get net operating income. Got it?
So what's so important about operating leverage?
Operating leverage is important because it's a big factor in business risks. Businesses want to minimize risks in order to bring in investors and be a sound investment for them.
Go.
So does every company have a high operating leverage, or?
No, certain companies have high operating leverages and others have lower operating leverages. Businesses that have high operating leverage are more volatile and there's more risk that they will not be able to pay their bills and will go bankrupt. Due to high capital investment requirements, new companies find it hard to enter the auto industry. Companies like Ford had to put up close to or more than $1 billion to set up new manufacturing plants. It can take years to break even on them. In other words, this industry has a high operating leverage because the fixed costs are astronomical and the variable costs are very small comparatively.
So how do companies keep from having a high operating leverage?
Well, companies in the auto industry used to have assembly lines for specific models of cars, and what they've done now is they have assembly lines that can produce multiple models of cars so that the fixed cost isn't quite as high for each product.
So what companies operate with the lower operating leverage?
A company that's a retailer such as Walmart operates with the low operating leverage because the bulk of their costs are variable costs of their goods. So as a result, the cost of goods continues to rise as the sales revenue increases. Walmart has fairly low levels of fixed cost while its variable costs are large. Merchandise inventory represents Walmart's largest cost. For each product that Walmart brings in, the company has to pay for the supply of that product, therefore decreasing their operating leverage.
You get it, right? Because I don't.
No, me neither. I'm sorry, Professor. Can you explain that more
An
clearly?
example is a company in 2000 called Inktomi, based in California, suffered the negative effects of a high operating leverage. As sales declined, their profits swung dramatically because of their high operating leverage. By the beginning of 2001, they had lost $58 million, plunging from the original profit that they had made. Their high leverage involved in counting on future sales to repay their fixed costs, and it put their company and shareholders at risk. Their high leverage for any kind of company during a downturn can be an Achilles heel. It will put pressure on profit margins and make earnings quotas unattainable.
Okay. Can you give me a quick review of that, please?
as you can see on the board, when fixed costs increase and variable costs decrease, high operating leverage is the result. But when fixed costs decrease and variable costs increase, the result is low operating leverage. So to review, when fixed costs are high and variable costs are low, the operating leverage is high. When fixed costs are low and variable costs are high, operating leverage is low.
Okay, Professor, I get it. Thank you.